So when we look at segmentation, we first have to define the market. What is the market? It is all the possible user base. Now, what is important to understand here from the application point of view is that sorry, as a company, we can define this market for ourselves. So let me take an example of ICICI Bank versus Citibank. In terms of services offered, they are all the same, and yet their target audience is different. So ICICI wants to cater to everybody like a PSU, whereas Citibank wants to cater only a select audience, and therefore they keep a minimum balance guideline to avoid others. So I hope you got the picture now, that you can define first the whole market for yourself and make it broader or smaller in terms of geography and other things. So you can even define the market by saying only NCR because this is where we want to operate first. Then you can call it a particular state, then a country, then global or whatever. So step one is define the market. Step two is use relevant parameters to break the market into homogeneous parts. Okay. So let's say parameter could be income group, could be gender, could be age, could be geography, and so on. So it's given in this presentation as well. So you can have a lot of demographic factors, you can have socio-economic factors, geographical consumption pattern, all that. So you can keep segmenting according to the product, use the relevant factors and segment. A question here which is important is that everything is a cost. So that should always be kept in mind. There is a marketing cost for everything that you do, and therefore that has to be always kept in mind, and sometimes we forget that getting data also is a cost, and at the end of the day if there is a problem then you have a greater issue, right? Because you have ended up getting a result which doesn't justify the cost you have spent. So ideally use only that data that is easily available or which is low cost, and then rest of it you can even make your own judgments. After you have segmented into homogeneous parts, can you hear me? My net is pretty good now. I'm not facing any issues.
Hi, this is Apurva. Actually, you are breaking a bit. Uh,
Okay. Let me just check if my speed once. Just give me 2 minutes. It seems to be showing everything fine here, but in any case, I will keep writing as well on the chat and here if you don't understand something. Okay, so always, and I'll be a little slower in speaking. So always keep a lookout on the cost of whatever you are doing because it gets added to your marketing cost. So even if only judgments are required, it's better to do that. Okay, is that clear now, Pankaj? So we get carried away sometimes when we do all these processes. That so if someone says, how do I get particular income groups and all, and I'll send someone to do a survey around, then that cost of survey may not get justified. So you have to make a lot of judgments and you have to take a lot of secondary data or already available data. So once you've broken it into parts, that is when the targeting happens. So those target groups, so it's like a pizza. You've cut them into different parts, then you go for what you really want. Okay. So for the targeting piece, you have to start defining that group which is most likely to buy your product. The group will be an intersection of all for some of the segmentation factors. Let me take an example. Suppose I take shaving cream. Now using gender here is no use because we're primarily doing it for the males. But maybe we'll take age 20 to 30, 30 to 40, 40 to 50 and so on. Then we take income which is less than 30K per month, 30 to 50K per month, above 50K per month. Take geography, metro, non-metro. Okay, so when we target, then we can have target group 1 is metro males in the age group 30 to 40 having an income of 30 to 50K per month. So this is how you start doing your target groups. Target group 2 could be all other things same except, so you repeat the same thing above 50K per month. So okay, so just by changing one parameter, the entire homogeneity of the group will change. So this is how you do your targeting, and then you do positioning. Positioning means using the appropriate communication medium to reach out to your selected target groups. So for target group 1, who have 30 to 40k, age group of 30 to 40 and have an income of 30 to 50k, maybe a Facebook will be a good medium. But in the same age group but over above 50k, maybe LinkedIn will be better. Or if you look at newspaper, the first one may have Times of India, the second may be more focused if you look at Economic Times. So positioning, basically this has a lot of impact on the costing. I'll give you some examples of this. We had a lot of startups, growers and all these, which didn't do too well. Reason being that they gave full page national ads, whereas the areas that they serviced were less than 30% of the country. Not even 30, that's also large, I think, probably 10% of the country. So giving a national ad which costs you close to 15 to 20 lakhs, and in which the readership may be 20 lakhs, but 18 lakh of those people are not even in your service area. You ended up wasting all that money for nothing. So you choose your medium so that you reach your selected target group and try to get maximum of those to get covered only, rather than just pick up any medium which is on a nationalized basis and create more of wastage. Okay, so that completes STP. Any questions on that? Any questions on STP? Okay, so I move on to the third presentation, which was of today. We've now done STP, we've done the 4Ps, we've done the NCDV model. We come to the next one, which is more of a company uh, position where we want to be. And more importantly, we want to understand the terms of market share, market growth, and sales growth. So I'll use a example of okay, so I'll use an example of an Excel sheet. These are figures that I've just put on my own. It does not, they're not actual figures. But I've taken 5 brands of smartphones of certain years, what are their sales, and I've put the remaining in others so that the total gives us the total sales of that category in the whole year. Now, the first thing is, what is market share? So can you all tell me market share? That's fairly simple. What is market share? What is market share? How much of the total market we hold? So if total is 400,000 and we sell 100,000 units of that, our share is That is market share. Now the total market is this number which is coming on top, the total. So our second uh, figure is market growth rate. What is market growth rate? Okay, so it is immaterial of what you do. It's what the entire industry does. All your competition put together. Okay, it's how the total changes. If you are a significant member of that total, you make an impact. If you are an insignificant member of that total, you make no impact. So if your market share is very low, you have no impact on market growth rate. But if your market share is high, you have an impact. So in the automobile space, Maruti holds over 50% market share in India, which means out of every 2 cars, one sold is a Maruti car. Now, if for some reason Maruti stops its production for 5-6 months, the market in totality will definitely drop drastically. At the same time, if we have a Nissan stopping its production, the entire market is unlikely to be impacted at all. So your market share is important from how much of the market you are driving. But the market growth rate has nothing to do with what you are doing, but it has more to do with what the rest of the whole competition is doing. Okay, so that's market growth. So if 2012 total category sale was 4 lakhs, and 2013 it becomes 8 lakhs, then the growth is 8 lakhs minus 4 lakhs, which is equal to 4 lakhs. And the growth percentage over the base year is equal to 4 lakhs divided by 4 lakhs into 100, which is equal to 100%. So the market grew from 4 lakhs to 8 lakhs, whether you contributed or you did not contribute. And therefore, the market growth rate is 100%. Now let's look at sales growth rate. So our sales was 1 lakh units and it grew by 50%. So it became 1 lakh 50,000 units. So sales growth rate is calculated just like market growth rate. Final sale minus initial, let's say 150 minus 1 lakh is equal to 50,000. Sales growth rate is into 100. Okay. So the sales growth, and I've taken that example there, that we grew from 1 lakh to 1,50,000, which is a healthy 50% growth. But what happened to our market share? Market share this year is 1,50,000 divided by 8 lakhs into 100, which is somewhere around 20%. So our market share has dropped by almost 5% despite a sales growth rate of 50%. So we come to the most important relationship here. To maintain market share, sales growth rate should be equal to market growth. Is this understood? So these are three important parameters in which a lot of people confuse and are not able to understand how it is to be applied or why it is relevant. So there's a lot of confusion that a lot of people have. Market share is simply what share of the market you hold. Market growth rate is how the entire market is moving. And sales growth rate is how you are moving. So despite a healthy sales growth rate, you might still lose market share if the market growth rate is faster. Any questions on this? Any questions on this? Yes, so if your growth rate is not matching market growth rate, it means competitors are growing at a faster pace and your market share is dropping. So coming to that example of Maruti now, Quid has sold almost a lakh last year, which means when the next figures of market share start coming, it is likely that even with a Maruti growing at 5%, because Renault is growing at more than 300% this year, the total market growth may be higher than the market growth of Maruti per se, and therefore they might slip from 52% market share to a lower market share. So a drop in market share does not mean your sales is dropping. Similarly, a growth in market share also does not mean that your sales is growing. A growth in market share can also mean that the competitor stopped operating and therefore your market share grew. These are very important things because a lot of people confuse this, and when they read up on this they tend to get carried away by not really understanding what the origin is. Okay, now I'll quickly give a little bit on the application of the BCG matrix. You don't have an assignment on BCG matrix. I plugged it in only because these three different things were supposed to be understood well. But I will talk a little on the application of BCG matrix. So if you see here, there are two axes. The x-axis is market share, the y-axis is market growth rate. And on that, these four quadrants have been plotted. Now, why the arrow of market share in the opposite direction from the traditional one, that I don't know. BCG stands for Boston Consulting Group, the company which you know shared this matrix with the world, and probably because they shared this matrix, so they had a right to put the arrows in whichever direction they wanted. So what is cash cow in terms of market growth rate and market share? What is cash cow in terms of market growth rate and market share? No, I am asking low high. Low or high? Or which quadrants come in low market growth rate and which quadrants come in high market growth rate? So cash cows and dogs are low market share. They are not high market share. Sorry, they are low market growth rate. Whereas stars and question marks come in high market growth rate. So as an entrepreneur, where will you like to be? You'd like to be in the star category or you'd like to be in the cash cow or a dog category? So my question again, as an entrepreneur, which is the segment that you want to be in always? Star, cash cow, dog. Obviously nobody wants to be a question mark. Yes. So everybody wants to be a star, but from the star, which is the quadrant where you are likely to move? If you don't be a star, then which is the quadrant you will be in? Exactly. So you will be always a question mark if you are not a star. A cash cow or a dog is only possible when market growth rate is low, which means it is a saturated market. It has lived through its product life cycle. So if you take the Maruti 800, nobody is trying to enter the 800 space to compete with the Maruti 800. In fact, Maruti 800 has been discontinued in the favor of Alto. But it is a cash cow for the company. They don't do much of advertising. They don't do much of spends. It delivers a lot of money to them and they make all their investments in the star category. So you always have advertisements around Baleno, Ciaz and such products because that is the category where the market is growing. That is, customers are looking for hatchbacks with a higher ground clearance, so somewhere between a cross of a SUV, the Vitara, the Balenos. People are looking for premium sedans. That is the space which is growing very fast. So all your advertising and everything happens there. And to maintain your market share in the star category, you have to be fighting with the competition there. You don't have much competition for a cash cow because nobody wants to invest in that. It is a star eventually will become a cash cow when the market will get saturated. So in the telecom space, the 2G and the 3G is now only a cash cow for Airtels and Vodafones which still operate 2G and 3G. But it is a dying market because everybody is shifting to 4G products. Reliance Jio is unlikely to come in 2G or 3G, or any new player is unlikely to invest in 2G or 3G to eat that market share which still exists there. So that is a cash cow for the Airtels and the Vodafones, that those who still have 2G only on their handsets or whatever have to use such operators, and they will keep giving money for that usage. But as they shift to the 4G, the competition will hot up and these geos and all will come into that space, and every company which has a cash cow product will use the money they are generating there to try and invest into creating stars. So that's the relevance of this. Yeah, so that's the reason they say move to 4G, because that's the growing market and that's where the longevity of a person stays. So even Vodafone and Airtel don't want you to move to a 4G of a competitor. They want you to move to 4G of their own. And they give you these free SIM cards and free changes and all those sort of things. So that's the relevance of the BCG matrix and how it's applied. A little more is written here so you'll understand that. As far as dogs are concerned, the dog by nature is a loyal guy, a loyal pet, and they don't need too much of maintenance. That is, a dog will survive on the means provided. That's why the word dog has been given. So some products like Ambassador or something like that, or a Maruti Omni van, they have a certain set of loyal customers, and just because the company wants to keep servicing those loyal customers, so they make that many of that. But neither does the dog give great returns to them in terms of revenue, and neither does the dog ask for too much for them. It just hangs around till it'll die. So that's why it's called a dog. The major area of operations of most products and companies is between question marks, stars, and cash cows. So any new company, any startup which starts will always have to be in a question mark category, because they will always operate in a high market growth rate segment. So if you look at mobile apps, it's heavily growing year on year, and so everybody wants to build an app. So you are in a high market growth rate segment. But when you're starting, your market share is very low, so you have to start as a question mark. How quickly you are able to transition from a question mark to a star category is the whole game of the business. And once you're in the star, you have to try and hold that position of star as long as possible, so that when the market cycle of that product starts declining, you have a cash cow in your hand which is generating a lot of money to service the other stars that you are trying to create. Have I been able to explain this reasonably? So for those of you who want to get into marketing and want to get into your entrepreneurship, please understand you will always start from a question mark, and therefore you will fund it heavily. A question mark is low share business in high growth markets, therefore it needs high investment to sustain. From here you move to a star where you still need heavy investment because there's rapid growth professional, that just like your Flipkarts and all that, but you're at least having very high market share even if the profitability is not there. And when that market consolidates or saturates, you have a cash cow on hand where you generate a lot of money out of having that market share in a saturated space, and you can invest that money now into newer products of the new generation and which can become stars. So companies will or products will die most from question mark category. They'll start from question mark and they'll die as a question mark. Those who are transitioning to the star will either end up retaining their position as a star or go back to question mark. Otherwise, once they have a star to a cash cow, then likelihood this cycle will keep churning. So a star will never die. A star will become a question mark and a die, or a star will become a cash cow and die. Or a cash cow or a star can become a dog and a die. But question mark can die there itself, which is what maximum happens. Okay. Any question on BCG? Otherwise, we move ahead. Okay. So you have a lot of assignments coming up since first is also not being done, so you have to do the first one. The second one is on STP. The third one is on this mathematics of a BCG matrix. And then you have one group assignment which is on the whole marketing space, a Great Dakota Bank case study, in which you have to do it on basically CLV and CAC, which is what I'm going to cover now. So if you go to the internet or if you talk to people in the marketing space, the two factors which everybody will be talking about will be customer lifetime value and customer acquisition cost. Only two things that everybody keeps talking about. But there is a whole lot of basic concepts which build up to this. And if someone is not understanding STP or NCDV or other things, the relevance of understanding this is completely lost and you will only make all sorts of incorrect decisions. So unfortunately on the net, if you try to look at value also, you will find a lot and lot of material on customer lifetime value, but you will find nothing on NCDV. Very, very difficult to find NCDV or SCV or something like that. So everybody is just focusing on the end part of it. Now, just like NCDV is the value delivered to the customer, CLV is the value got from the customers. Okay. NCDV is value delivered to the customer from the customer. Now, obviously, if you want to get value from a customer, you have to deliver something first. And understanding the delivery part well will ensure that you will be able to derive a value as well. Because if the value is not delivered, then expecting a value is also very difficult. So if we say a CLV is based on three factors, and I say the cost to acquire the customer is A, the annual profit the customer generates for the firm is B, and the number of years the customer is likely to purchase from the firm is C, then what should be the formula of CLV in terms of ABC? Yes. So cost to acquire the customer is A. Annual profit the customer generates from the firm is B. Number of years the customer is likely to purchase from the firm is C. And in terms of ABC, what should be the formula of CLV? B divided by A into C. B is, so you're saying annual profit divided by number of years into cost to acquire. How is that the value derived? So try and do it like that. How much do you gain minus how much do you spend? When you do NCDV also you do total value derived minus total cost spent. So here also B plus C, annual profit plus number of years. So Ajay, a little correction there. It can't be annual profit plus number of years. They are not the same unit. So if annual profit is 20,000 per annum, then 20,000 plus 5 years makes no sense. So little correction has to be done in that. Ajay, make the correction. What is the relation in B and C? Total revenue got minus cost spent. So B into C minus A. Total revenue generated is equal to B minus C. B into C. And total cost spent equal to B. If you see here, they have talked about annual profit. So annual profit already includes a certain cost. So therefore, the first is cost to acquire the customer. The annual profit assumes that there is a cost to retain the customer, and after that there is a profit you are generating. And then the number of years the customer is likely to purchase. So the CLV is annual contribution from a customer into number of expected years of purchasing life minus the acquisition cost. So let's take an example. Let's take an example. So which mobile operator do you use? Anybody? Which mobile operator do you use? Okay, Vodafone. And what is your average monthly bill? Ajay, what is your average monthly bill? Average monthly. So total revenue you give them is 7,200 per year, out of which if their profit margin is 15%, then they may go to 1,000. M is equal to rupees 1,000. Okay. Ajay, how long have you been using Vodafone? So 2 years already used, and assuming he sticks for another 3 years, total lifespan is 5 years. Okay, so generally you get the average span of a person who sticks around. So L is equal to 5 years. So total revenue contribution is equal to M into L. 1,000. Now we have acquisition cost. What is acquisition cost? The actual cost spent in acquiring a new customer is acquisition cost. So AC can be zero also. So if Ajay went himself to a Vodafone store without getting, without going because of a particular advertisement or because someone reached out to him, then he could also be just buying with zero acquisition cost to the company. But and in fact that does happen for a lot of established players. But generally, suppose a new player has to come, they will run an advertising campaign and they will have a sales force, then they will give some discounts, etc. So all the costs put together, let's say total cost came to 10 lakhs and number of customers who actually converted were 1,000. So what was acquisition cost per customer? So what was acquisition cost per customer? ₹10 lakh divided by 1,000 customers. 1,000. CLV is equal to 5,000. Okay. Now application. So if someone wants to understand how you have sold yourself to CLV already has a service cost. No, I have not taken the revenue as 7,200. I have taken M as only the profit margin. So 85% is already the service cost in this. So the profit margin into 5 years is the total revenue you've given to the company after taking out their service costs. And the initial first time cost of getting you on board, even if it is 1,000 rupees, the company has still made 4,000 from you overall. Now, of course, it is not as simple a calculation as it looks here. It is easier to do this from a teaching perspective, but how the actual calculation is that M is broken into M1, M2, M3 and so on for L1, L2, L3 and so on. So suppose we take a Flipkart and we say first year M is equal to minus 10%. So on every sale we are actually losing 10%, and if average sale of a customer is 1,000 rupees, then M is equal to minus 100 rupees. So first year I lost 100 rupees. Then second year M is equal to 0, that is I am on equal footing. So I got no margin. Then third year I made M equal to 10%. So I got 1,000. Then fourth year and so on. Okay, so there are a lot of estimates and guesstimates, and people make up very big charts and all that and show that over so many years we will make a killing and we'll make all this profit, because at the end of the day you can't sell anything in a business till you don't show how you are generating that value. Now the other place where you can convert is that you can say in the second year the margin didn't change, but I got 10,000 here because by this time average sale went up to 1 lakh. So I started making a killing from the third year itself. So this is how people, in marketing will show all sorts of figures and make you believe. And then when nothing happens at the end, then they say the market was bad and XYZ, but the money is already blown. And therefore everything has gone kaput. So traditionally everybody will still say hold your cash and don't throw it away so easily. So like we said over here, acquisition cost, if the converted customers drops from an estimated 1,000 to an actual 100, acquisition cost goes up to 10,000 per customer. Now the CLV has become minus 5,000. So even if you are serviced for 5 years, your acquisition cost was so high that at the end of the day, you will always end up being a loss proposition to the company. So this is the reason why these two figures are the only talked about figures in the industry. But at the same time, these few parameters which look so simple have a lot of depth inside that, which can tell you how variations can be easily made and anybody can be fooled by just a presentation. And that is what that actually happens. So now the reality of the situation is that if you're the one giving the presentation, you're always showing the rosy picture. And if you're the one who's taking the presentation, then you're always trying to be pessimistic about that presentation and say this is not possible, that is not possible, and come to a more realistic figure. So depending on which side of the table you are going to be reading and seeing this presentation and reacting accordingly. So that's how it's going to work. Any questions so far? So the whole course finally boils down to these two figures, which in itself have very little theory in themselves, and only takes about 15 to 20 minutes to cover. But on the net and everywhere, you'll get only CLV and CAC that everybody talks about. And hopefully by now you understood all the background of how these two figures got built and how the variations should be really looked at to ensure you make a proper marketing plan. If there are any questions here, tell me, otherwise I will give you more tips on what are the real ways you use it on the ground. Okay. Pankaj, any question from your side? Okay. So the first and most important thing here, only consider actual costs, acquisition cost, i.e. actually. So taking the same Vodafone example, suppose I take out a campaign, free SMS between 10 p.m. and 6 a.m. So Ajay, are you married? Ajay, are you married? Okay. So Ajay is already married. But assuming Ajay is a bachelor and Ajay is already getting some dreams now, and he is in his courtship period again, when all the interaction happens between 10 p.m. and 6 a.m. Okay, so Ajay quickly goes and buys this SIM card from Vodafone and becomes their customer. Now, Ajay uses this free facility for 3 months and does 5,000 SMS or 50,000 SMS during that period. Cost of SMS to customer by company is 1 rupee. So did the company spend 50,000 rupees in getting Ajay on board? So what did the company spend to get Ajay on board? So what did the company spend to get Ajay on board? What is that cost? 50,000 SMS. So actual cost to company of one SMS, 1 paisa. So total cost spent. So for them, the acquisition cost was 500. Okay, whereas perceived value to the customer was, therefore giving own product is always the best promotion. Okay, so when you say buy one and get one free, and MRP of a shirt is 1000. Okay, cost of shirt to company is 100. Then what is the acquisition cost? Think again. It's buy one get one free. Yes. So one free is rupees 100. The best part in this example is that assuming L is equal to 1, that is, customer will not come back after this scheme for repeat purchase. Okay, so M into L is equal to 1000 minus 100 star 1 is equal to 900 and AC is equal to 100. So CLV is equal to 900 minus 100. So even if a person buys only once, it is still viable to the company, which is why you will see lot of brands, Coutons, County something, etc., which are on permanent schemes like this. Let's take one more example. So ShopClose gives you 100% cashback on first purchase to a maximum of rupees 5. So worst case scenario, customer buys exactly for rupees 5. retail margin is say 30%. So now tell me, what is the acquisition cost? So let's look at the whole transaction. Transaction 1, spend 500, get back cash in shop close account of 500. Company gets 150 as transaction 2, spend 500 that was given as cashback, cannot be spent anywhere else or so company gets margin again of 1. So effectively customer gave rupees 500 and company earned rupees 300. So net loss was for the first time user for acquisition scheme spent. Now if you see, I've written their worst case scenario, because when you actually go to buy, exactly 500 is very difficult. You like something, you'll end up taking 700, 800, because you don't want just anything for the heck of it. And you're happy enough that even on 800 you're getting back 500. So if suppose in the first transaction you have spent 800, company has got back 240, and on the second transaction also you end up spending 800, or you say you spent 900, company gets back 270. So effectively you spent 500. So let's reduce this to 500 because you got only 500 cash back. So you get 150. So effectively again, by giving that 500 cash back, the total return to the company is still 390 and the cost of acquisition is only 110. So these are the areas where you're neither fooling anybody, you're neither doing anything illegal. The customer is also feeling comparatively very happy, because when you say 100% cashback, the person feels that he's got it free, and free में है तो ले ही लेते हैं for the first time, and so the acquisition becomes very easy. Effectively, the cost of acquisition is not very high. This part clear, or you need any more examples on this? Okay, so in the last assignment, that is the Great Dakota case study, You can do it as a group if you like. You can do it individually, but even if you do it as a group, just ensure that you individually put it up on the LMS for me to give your grading. And in that, basically CLV, CAC has to be found, and then assuming you're the marketing manager, you can redo the campaign. So what would you do? So it's assignments after this. As far as my last session is concerned, on the next Sunday, I'm not available next Saturday. I'll be taking it next Sunday evening. At that time, I will take up any doubts anybody has of the entire course. Anything you want to ask in marketing beyond this, I can take that up as well. Otherwise, as far as my course is concerned, I have more or less covered everything. The rest, only when I get some doubts, it gets easier to explain. Uh, so I'll take a couple of things that I remember from past that people used to ask. How to find L. So if you have historic data, you can find average life of customers. You can make an estimate. 1 divided by churn rate is also a good answer. So what is churn rate? Suppose you have 100 customers and every year average churn is 20. That is 20 leave and 20 new join. So one can assume that 1 divided by churn rate, 1 divided by 20%, 5 years is the lifespan. Okay, so if 20 are coming every year, 20 are going every year out of 100, that's another way of finding L. And it means over a 5-year span, everybody leaves and a new person comes in. How to find M? This is something called skip for startups. It is one knows it's so that's it. That's what I had to share. If anybody has any questions, I can take that. Otherwise, I'll wind up for today, leave you for a week, and then you can ask me whatever on the final Sunday. I'll put all the presentations and I'll put this Word doc also on the LMS. Okay, I guess no new questions are there, so I think you can digest all that I've covered today, and then I can pick up questions again. Thanks a lot. And